this video, I'm going to talk about the 8 most common credit card mistakes that I see a lot of people making. By not understanding how to properly use credit cards, it can cause you to lose hundreds, if not thousands of dollars, as well as cause you to miss out on the opportunity for rewards, have a lower credit score, higher interest rates, and the added financial stress. I hope that after watching this video, you'll be better equipped to avoid these mistakes, optimize the usage benefits of your cards, and have a successful credit journey. So to get it started, the first mistake is carrying a credit card balance. This is one mistake that I believe is widely overlooked by a large amount of people. In the US, there's around 47% of cardholders carrying their debt over from month to month. It's important to know the difference between having a balance in your credit card and carrying over a balance in your credit card. To keep it simple, your credit card balance is the total amount of credit that you've used on your card from purchases. So whether you buy some clothes, a plane ticket, a snack from the store, each month you'll get a statement from the credit card company with a list of what you bought. This is when you need to pay back what you owe, or else you'll be charged interest. For example, let's say you've been using your card within the past month and you received your statement, which has a balance of $800. If you decide, well, I'm only gonna pay some of it, so you end up paying $400 towards your statement. This will leave you with a leftover balance of $400, which will be charged interest. So this $400 that you have left over is then carried over into the next month. This is how credit card debt can continue to stack up and get bigger and bigger, with the interest charges adding on each month. People dig themselves in a hole with credit card debt, oftentimes because they stretch out their payments over time, and at some point they're unable to catch up to paying down their debt faster than the speed that it's growing at. It's important to always pay your balances in full and don't spend any money that you don't have, so you can prevent yourself from falling into this trap. Maxing out your credit limit or having high credit utilization. The mistake of using too much of my credit limit is something I fell into when I first started out with credit cards. And when you use your credit card to buy something, it affects your credit utilization. Credit utilization is simply a percentage of the amount of credit that you've used out of your total credit limit. For example, let's say you have a $1,000 credit limit and you have a balance from your purchases of that month of $500. That would be a credit utilization of 50%. So in the case that you maxed out your credit limit, that would mean you would have had a balance of $1,000 with your $1,000 credit limit, which leaves you with a credit utilization of 100%. Now, experts recommend that you keep your utilization rate below 30%, as lenders view a higher utilization to a higher risk borrower that may not pay back. But trying to keep it in the single digits under 10% is going to be much better for your score. Credit utilization falls under the credit owed category, which makes up the second largest amount of your credit score at 30%. So you can see how having a high utilization rate can have a major impact on your score. The lower the utilization, the better. Now, there are some things you should take note of to be sure you report low utilization. First is to find out your statement closing date, which is where credit card issuers calculate your statement balance and report your balance and credit utilization. This date tends to be around the same day every month, and what you want to do is pay down some of your balance in advance to a lower amount so that lower utilization will be reported. So if you did manage to use a large portion of your credit limit, be sure to pay down ahead of time before that statement closing date, as well as to bring the balance down low enough to have a utilization rate of 10% or less. It's also worth noting that your credit utilization percentage is not just for individual cards, but the scoring model also considers your total credit utilization across all the cards you have combined. Missing a credit card payment. This mistake is how people can manage to really ruin their credit score in a short amount of time, as missing a payment can have a huge impact on your credit score. Your payment history makes up 35% of your credit score, so it's one of the most important parts of your credit to focus on, since it's the largest category that plays into your credit score. Just having one late payment could drop your score as much as 40 to even 80 points or more. So you can see that it's essential that you avoid any late payments, and that your goal should be to have 100% on-time payment history. Now, the good news is there are a few things you can do to help avoid this. First thing is, you can change your payment due dates. If you have a due date at an inconvenient time of the month, or you're having some trouble keeping track of your payments because they all fall on different dates, you can set all your due dates for the same day or the same week, or even closer to a time when you get paid. You can also set up due date reminders. Depending on your credit card issuer, in most cases, you can set up your account to receive payment reminders by text or email before your due date. Or you can do it yourself and set a date on your phone or calendar to remind you when you have an upcoming bill due. Another great option is setting up auto pay so you have a safety net. That way, for whatever reason, if you accidentally miss a payment, you'll still be covered, and you can decide how much you want to set for auto pay, whether it's a specific amount, the full statement balance, or the minimum payment. Now, even just the minimum payment is all you would need to still be considered as an on-time payment. But you should always pay off your cards in full and on time. I think it's still a good idea to monitor your credit card during the month. Check that your purchases are correct and ensure that your balance is paid off in full in advance, while using auto pay as a backup to cover you in case you somehow manage to miss a month. Not treating a credit card like a debit card. What this means is when it comes to purchasing things, your approach should be to view your credit card as your debit card and only use it to buy things you already have the money for saved in the bank. That way, you can pay off that credit card balance in full completely by the statement date. But oftentimes, this is not the case, and people see that the bank gave them a $6,000 credit limit, and they make the mistake of thinking they can just borrow against that amount as they please and not have to worry about paying it back until a later time, without having an idea of when or how they will pay off their debt. The credit card companies capitalize on people that don't have a decent understanding of how their credit card works, and they know that they can charge you crazy high interest rates of over 15, 20, and 25% if you have any balance left over at the end of the month, which is effortless profit for these credit card companies. Although these days, there are so many people depending on credit cards to help get them by week to week, and as tempting as it may seem, you must avoid spending money based on the fact that you're gonna get paid in another week or two, because it really only takes one misstep to quickly hurt your credit score and put you further into credit card debt. For this reason, it's really important to have some type of savings to allow you to be able to cover an unexpected emergency expense. This is all to say, credit cards are not free money. What you spend, you must pay back. And what you spend on credit cards should be the same amount as what you'd be spending in cash or on your debit card. While at the same time, the credit card will be giving you different purchase protections, a variety of benefits, points for travel or cashback rewards, and most importantly, help you in building your credit. Using the wrong credit cards. A lot of times, people are getting credit cards without having any type of strategy for using them, such as using one card for all your purchases that might be only earning 1%, which in reality is leaving so much unrealized value that you could be getting back. While there isn't the perfect everything card, the card that best suits you will depend on your goals and lifestyle. This doesn't mean that you'll need to have 12 different credit cards, but you could definitely optimize on your spending with just a few cards that are able to earn points or cash back in categories that you spend the highest in. You should be able to have a clear picture of your card choices after thinking through some questions for yourself. Things like, are you okay with paying an annual fee? Do you want a card geared towards travel rewards or cash back? What categories do you tend to spend the most money in, like dining and groceries? What type of travel do you want? Do you care if the redemption process is simple or more complicated with bigger rewards? Do the benefits of the card match with your lifestyle? And are you willing to manage multiple cards to maximize your opportunity for benefits? There is no one-size-fits-all strategy, and just because a particular card may have some buzz or hype behind it, doesn't mean that that's a card that you have to get. It's really about what do you value and what it is you're trying to achieve, and by answering these type of questions, it'll help you pick what's right for you to reach those goals. Also, after this video, you can take a look at a previous video I made about cards that can earn you cash back on your rent, groceries, and eating out, as well as cards focused on miles and travel rewards, which I'll link in the description below. 0% interest debt trap. Now, this is a trap because credit card companies need to find ways to get the attention of consumers and persuade you to sign up for their card over their competitors. For this reason, you see so many card providers marketing all these 0% interest rates on credit cards or balance transfers. The credit card companies know that the interest rates are very important to the consumers, especially the ones who oftentimes carry a balance. So these 0% offers are a way to get signups. I'm sure 0% interest for 15 months seems pretty good, but imagine someone gets a new credit card to take advantage of 0% interest, and they buy some new furniture and a TV that costs $3,500. Now, they won't have to pay it all up front, and they can make smaller payments each month without interest, but this is where the risk can come into play. That $3,500 balance on the credit card won't cost you interest for the period of months offered, but depending on what your credit limit is, this could cause higher credit utilization, which can hurt your credit score, and like mentioned before, should be kept below 10%. The other problem that can occur is if you manage to miss a payment during the 0% intro period. With just even one late payment, some issuers would take away that 0% rate and replace it with a much higher penalty rate, close to 30%, which would be above the card's regular interest rate, along with their score taking a hit. So it's important to be aware and responsible when it comes to getting into 0% credit cards. Now, there are some ways you can benefit from a 0% offer, and one way would be if you're doing a balance transfer. And a balance transfer is when you're transferring over a balance from another credit card, more than likely one that has a higher interest rate. So while you might just be charged a one-time balance transfer fee, the 0% rate will allow you to work on paying off that balance without being charged the interest for that period of time. The other way is with a 0% APR business credit card. By opening up one of these for your business, not only will you be able to have a balance at a 0% interest rate, but also most business cards do not report to your personal credit report. So you'll be able to avoid the negative impact of the utilization rate. And if you are looking for a business card for this reason, just be sure to check with the issuer that the card doesn't report to the consumer credit bureaus. Closing old cards that you aren't using. I think one of the biggest misunderstandings with people and credit cards is whether or not they should close old cards. A lot of people assume if they aren't using or don't need a credit card anymore, then the best thing to do is just to close it. And that couldn't be further from the truth, especially with no annual fee cards. While you have other financial products like brokerage accounts, savings accounts, and checking accounts, where if you decide to move your money somewhere else and you no longer plan on using them, then it makes sense just to close them. With credit cards, it's quite the opposite. And by closing an old card, it can negatively impact your score. Even if you aren't using that card anymore, there's still an open credit card account on your credit report for that card. And if that's your oldest card, by closing that account, in time, it'll end up causing it to fall off your report and hurt your average credit age. Credit history makes up 15% of your total score, and that considers the average age of all your accounts, as well as the age of your oldest and newest accounts. To give you an example, let's say you have 3 credit cards, and the oldest card you had for 10 years, one for 3 years, and one for 2 years. To calculate your average credit length history, the credit agencies would take the 3 cards you have and add the length of each one together. Then divide this total length by the amount of cards that you have, which in this case is 3. That would give you an average credit age of 5 years. Now imagine, with those same 3 cards, if you had decided to close your oldest credit card, your new credit age would be determined from your 3-year-old and your 2-year-old cards. This would give you a total age of 5 years combined and an average credit age of 2.5 years. You would have lost half your average credit age from closing that card. So you can see that you should really try to keep your accounts open as long as possible to avoid hurting your age of credit. For the old cards that you aren't using anymore, be sure to use them at least every 6 to 12 months. You don't want to risk them being closed accidentally after too much time of inactivity, since some credit issuers will close down accounts due to too much time of no activity. This could be any small purchase you make on the card, but there's an easy way to manage this, especially if you have multiple cards. Simply by saving the cards on Amazon and using Amazon Reload, which will allow you to use your credit card to load your Amazon gift card balance. And this way, you can load a few dollars per card to ensure that you keep those cards active. And in the case that you do have a card with an expensive annual fee that you aren't using and would like to close, before canceling it, check to see if your card issuer offers downgrading your card, so you can switch to a card that's more affordable or with no fee. Chase, Citi, Capital One, Amex, and some others offer the ability to downgrade to a lower tier card based on the current card you have. While you would receive a new card and card number, your credit account limit, history, and score would not change. Be sure to reach out to your card issuer's customer service to find out more about the terms and if this would be a possible option for you. Applying for too many cards at once. Now this is an easy mistake to make, especially when you hear about all these great sign-up bonuses with people using their points to be able to travel with business or first class or get into nice hotel suites for free. It can be tempting to apply for a bunch of cards at the same time, but do yourself the favor and don't do that. Applying for new cards has an effect on your credit score, so you'll need to play it slow and be patient when it comes to this process. So once you apply for a new credit card, the credit issuer is going to do a hard inquiry, or also known as a hard pull. And this is part of the application process where the credit card company checks your credit score and credit report to see if you're responsible enough to pay back the debt. The hard inquiries do show up on your credit report, and they will stay there temporarily for up to 2 years. But after a few months to a year, they won't have much of an effect on your credit score. To get a better understanding of how much these hard inquiries play a role into your credit score, when it comes to the factors that make up your score, applying for new credit cards will fall under the category of new credit, which makes up 10% of your total credit calculation. These hard inquiries basically serve as a timeline to show lenders when you've applied for new credit and how often you're applying for new credit. As applying for new credit too often will raise a red flag with the card issuer and can be viewed as you being riskier or desperate for credit. If you are a beginner or in the early stages of building your credit, applying for too many cards will cause you to also take on too many hard inquiries. In a short time period, not only will this cause lenders to just about automatically deny you on new applications, but doing this will also cause your credit score to have a considerable drop. And a lower score will also make it tougher in the future to get new credit cards, as well as it will affect your rates on any other type of loans, whether it's personal, auto, or even mortgage. If you are new to credit cards or working on building back your credit, it's probably in your best interest to wait at least 6 months between applying for new cards. Now, there isn't any set rules on how many cards to apply for or to get in your first year, but starting out, your priority should be to increase your score, make your payments on time, and to build your history so you can qualify for better cards down the road. If you found this video helpful, please be sure to hit the thumbs up and subscribe to the channel. Let me know in the comments section what mistakes have you made with credit cards, or if you have any other questions or comments. Thanks for watching, and I'll see you in the next one.